If you're an American living abroad, you've probably heard of the Foreign Earned Income Exclusion. What most videos don't tell you is that the FEIE isn't always the right tool. In some countries, using it costs you more than the alternative. There's a second, less talked about tool called the foreign tax credit. And for a lot of Americans abroad, especially those in higher tax countries, it's the better choice. Today, I'm going to walk you through exactly how to decide which one is right for you. I'm Vincenzo. I left a Wall Street career 15 years ago to live abroad, and I've been running an international tax firm ever since, working with Americans in over 100 countries. This is one of the most common decisions we run for clients, and there's no universal answer. The right choice depends on your specific country, your specific income, and your 5-year plan. We'll cover what each tool actually does, the countries where each one clearly wins, and the 3 factors that decide it in the middle, and the one costly mistake people make when they switch between them. And finally, a couple of bonus situations where the FTC works in your favor. Here's the plain English version. The FEIE, or the Foreign Earned Income Exclusion, lets you exclude up to $130,000 of foreign earned income from U.S. federal tax. You claim it on Form 2555. If your income is below the limit and you qualify, your U.S. tax on that earned income is effectively zero. The FTC, the foreign tax credit, works differently. Instead of excluding income, it gives you a dollar-for-dollar credit against your U.S. tax for income taxes you've already paid to another country. You claim it on Form 1116. So if you paid $10,000 in tax to Germany, you get a $10,000 tax credit against what you'd otherwise owe in the United States. The 2 tools address the same underlying problem, double taxation, but they approach it from opposite directions. The FEIE removes the income from the calculation, the FTC removes the tax from the bill. Which one wins depends heavily on where you live, and this is where the strategy starts to actually matter. Let me get you the clean edges of the decision first, then we'll deal with the messy middle. The FEIE wins when you live in a low tax or no tax country. Places like the UAE, Panama, Hong Kong, Singapore, and certain territorial tax jurisdictions where you're paying a little to no income tax. If there's no local tax bill to credit against, the FTC gives you nothing. The FEIE gives you the full exclusion. The FTC wins when you live in a high tax country. Places like Germany, France, Denmark, the UK, Australia, basically any country in Western Europe, unless you're under a favorable tax regime like in Portugal with the NHR, right? Because you're already paying more in local tax than you'd owe the US on the same income. So that excess tax that you paid abroad becomes a credit that you can use, and any credit that you don't use can carry forward for up to 10 years, which means down the road, if your situation changes, you have a bank of foreign taxes that's ready to offset future US tax. The FEIE gives you nothing to carry forward. Once you use it in a given year, it's used. These are the clean edges. Most people live somewhere in the middle, in a country with moderate tax rates, and that's where the 3 specific factors decide the answer. Factor 1, your income level. If you're earning under the FEIE limit of $130,000, the FEIE can shield your entire income from U.S. federal tax cleanly. If you're earning above the limit, the FEIE still helps for the excluded portion, but you also need to plan about what happens above it. The FTC can often cover the overage. Factor 2, whether you're self-employed. Here's the trap most people miss. The FEIE reduces your income tax, but it does not reduce your self-employment tax. That 15.3% for Social Security and Medicare still applies. However, the FEIE versus FTC choice doesn't affect your self-employment tax at all. The only thing that eliminates U.S. self-employment tax is a totalization agreement, which is not the same as a tax treaty. Factor 3, your 5-year plan. The FTC lets you build up unused credits that carry forward. So if you expect your income to fluctuate, having a bank of foreign tax credits can save you real money later on. The FEIE gives you nothing to carry forward. Now, once you've decided, there's one more thing to know, and this mistake is the one that costs people the most. Here's the trap. Once you claim the FEIE and later revoke it, usually to switch to the FTC, you cannot claim the FEIE again for the next 5 years without formal IRS approval. That's a big deal because your situation might change. You might move from a high tax country back to a low tax one. You might have a year where the FEIE is clearly the better tool and you're locked out. We've had clients switch away from the FEIE for what looked like a good reason in 1 year, then move back to a low tax country the next year and lose access to the FEIE for the next 4 years without the option to get it back. So before you revoke the FEIE, run a 5-year tax projection, not a 1-year comparison, because the decision is a 5-year decision, whether you meant it to be or not. Now here's the bonus. There are 2 situations where the FTC may work in your benefit if you're paying tax locally. 1, if you have US citizen dependent children and you qualify for the child tax credit. So taxpayers earning under $200,000 if they're single or head of household, or $400,000 married filing jointly, may qualify for the child tax credit. In these cases, taking the FTC is better. I have clients every year that have the FTC knock out all of their US taxes owed, and then on top of that, get a refund of a few $1,000s for the child tax credit. It's great because it covers our tax prep fee and then some. In case you're missing out on this credit, come to us and we can amend for prior years to give you that tax credit. Your kids need to have SSNs to qualify. So this wouldn't work if you had 0 income on your tax return from the FEIE. You need to show income to qualify for the child tax credit. Situation 2, if you want to make a contribution to your IRA, whether traditional or Roth, you need to be able to show income. If all of your income is excluded under FEIE, then you could not contribute to your IRA. Every year we have clients that come to us after already have contributed to their IRA, but have excluded all of their income under FEIE. So we either need to back out the contribution or revoke the exclusion. But if you did spend some time in the States that year, we could also do an allocation of earned income as taxable in order to make this contribution. This all requires an analysis. Here's the honest summary. If you live in a no tax or low tax country, the FEIE is usually always the answer. If you live in a high tax country, the FTC usually wins. If you're in the middle, the answer depends on your income level, whether you're self-employed, and what your next 5 years looks like. There's no universal right answer. There's only the right answer for your specific situation. If you want to go deeper on the FEIE side of this decision specifically, the next video on the screen breaks down the 4 most common ways Americans accidentally disqualify themselves from the FEIE without even realizing it. Watch that one next. And if you want us to run this decision on your actual numbers in your actual country with your actual income mix, the link below will get you on a call with our team. This is the kind of analysis that pays for itself many times over. Thank you.